I'm Lisa Abramowicz. Welcome to Bloomberg Money Undercover, a show that provides valuable insights into alternative investments. We take you inside the world of private debt, equity, and real estate. Well, let's get straight to the burning issues in private markets. The Fed and Chair Jay Powell make an emergency half-point rate cut. We examine the private market stress taking hold. Some of the year's hottest IPOs at risk, with travel and entertainment taking a hit, and distress deepening in the shale patch and beyond, raising the question, when's a good time to buy? Let's get into some of these burning issues. With me is Bloomberg's Sonali Basak, Damian Sassower, and Allison McNelia. Sonali, let's get started with you. And Sonali, just as this week on this show, Renaissance's Capital, Kathleen Smith told us how the volatility could affect the IPO pipeline.
The IPO market shuts down, which is happening now, and we're not sure how long it will be. Then one path to liquidity is gone. If the market is telling us that we're in a recession, private companies are businesses just like public companies. So if those companies are stressed, they don't have as many avenues of liquidity.
So, Sonali, have we actually seen any IPOs getting delayed or perhaps even pulled?
So Warner Music and Cole Haan are the two that people are talking about that have delayed their IPOs. There's a specialty chemicals company that has a lot of exposure to China that Carlyle owns that has also been delayed because of a lot of these global fears around the coronavirus. Remember, volatility in the markets has been hitting levels that are higher than the highest levels we've seen at any point last year. And so it's really hard to take a company public when you just don't know what the investor appetite will be for buying those new shares.
And Airbnb was arguably the most hotly anticipated IPO of the year. And it's uniquely hit because not only is it an initial public offering, a potential unicorn in this environment, but they also are more directly hit by the travel sector and the sort of slowdown there.
That's absolutely right. Because remember, in 2017 and 2018, my colleague Olivia Carville had written that they were profitable those years before interest, amortization, and depreciation. In 2019, that was not the case. And that was before the coronavirus even started to impact travel. And they've been letting guests going to China cancel their reservations without any penalty. So yes, does it take an impact to the revenue stream and potentially their bottom line? Absolutely. That's a hard thing when your valuation has been propped up to $31 billion in the private market already.
Meanwhile, over in emerging markets, there's a question about the epicenter of the outbreak. It was in China. There's a question of how it's moving around the world and how it's affecting the developing markets. Damian Sassower with us. Can you get a sense, based on the fact that we're getting a 50 basis point rate cut from the Fed, the first emergency cut of this nature intra-meeting since the crisis, what will the effect be on demand for emerging market assets?
Well, emerging market local currency assets are still going to suffer, in my opinion, simply because the markets need to take time to come to grips with exactly what is happening here in terms of how low are we going to go in yields. But one thing is absolutely certain. If you're looking at U.S. dollar asset classes like investment grade, high yield, and emerging market U.S. dollar debt, what it does, these falling yields, is it leaves spreads that much wider. And what that means is that's going to be idiosyncratic factors like sector, country-specific issues that are going to drive returns, in my opinion, going forward. And so that's something that markets need to keep a closer eye on.
There's a question over the past decade, the low interest rates has pushed more investors into private market assets seeking higher returns and into emerging markets in particular. I'm just wondering why that argument won't necessarily take hold this time.
Well, I think a lot of that is going to be short duration debt, quite frankly, and that's going to obviously get hit when the front end is falling, and what we've seen in markets, right? I'm talking bank loans, I'm talking private debt. A lot of that is shorter duration of nature. Emerging market dollar bonds are much more longer duration in nature, and certainly the investment grade component of that, what you see is that, spreads are now almost 50% of yield to worst. I mean, that is 1 to 1.5 standard deviations above the 10-year average. It's pretty big. A lot of juice there for markets to basically extract some spread return over the near term.
Given the fact that China was the epicenter and that the supply chain to the U.S. was not the only one, but also Southeast Asia, are there other economies that you think will be uniquely impacted to the negative, to the downside, that perhaps people are starting to pull their money out of?
Yeah, no, I mean, you're definitely seeing people pulling their money out of Indonesia. Indonesia government bonds, which has been a star performer for the better part of the last year. You've seen a lot of outflows of recent days and recent weeks, quite frankly. But I think really you have to take a step back and you have to differentiate, like you said, between local currency and hard currency, and it's going to be a hard currency play. If you're going to invest in emerging markets, you're going to want to do it on a dollar-denominated basis in this market because you just don't know where the dollar is going to go next.
And that really goes to the heart of the question of the day, of the year, which is the Federal Reserve responding in an emergency sense to stimulate the economy, or responding to a reality that means less demand, less growth, lower oil prices, which we've already seen this year? Which brings me to you, Allison. People wondering how many more bankruptcies will occur in the shale patch, given the fact that we're seeing ongoing distress in some of these oil companies. Can you give us a sense of what we're seeing so far based on the plunge in oil valuations that we've seen year to date?
So yes, we've started to see more energy companies selling off yet again. You know, this has been an ongoing theme for energy companies. How much further do they have to go? But with oil now below $50 a barrel, that's really sort of a psychological pressure point for investors, and that's largely driven by coronavirus, fears of a global slowdown, which would mean less demand for oil, less demand for natural gas and those sort of products. And so it's really all kind of mixed together. And that's also happening at the same time as we've seen energy companies reporting really disappointing earnings, you know, not meeting their production targets, not meeting their earnings targets. So with lower oil, expected lower demand, and disappointing earnings, people are starting to expect that we might see more bankruptcies in the energy sector.
Well, Allison, that's where I wanted to go with this, is how far in the washout we are, because I remember back in 2015, 2016, it got pretty ugly and people said, okay, we're all clear, we've had some kind of catharsis. This time around, how close are we to that?
So we're still a ways away from what we saw in 2016. In 2019, so last year, we actually saw the highest number of bankruptcies since 2016, but this year it's been fairly muted. What we're seeing is really sort of distress in the price of trading, so, you know, in bonds, in loans, in equities, but we haven't yet seen that uptick in filings, although people are certainly watching to see if those trading numbers, of those earnings results, of those oil prices will lead to more bankruptcy filings.
Allison McNeely and all our reporters, thank you so much. As we look at a Federal Reserve emergency rate cut and possible intervention around the globe as the coronavirus takes hold, there is a question: what will the effect be on small to medium-sized businesses? These seem to be the most vulnerable. So it's fantastic that we can speak with Brett Hickey, Chief Executive Officer and founder of Star Mountain Capital, which extends loans and provides equity investments in smaller and mid-sized companies. Brett, as you take a look at the change in sentiment over the past few weeks as coronavirus has taken hold, does that change any of your theses, your investment theses, when it comes to small and medium-sized businesses?
It's a great question. We're continually focused on concerns we've had for years now, and it's been a matter of wondering when the next cycle will come. So I think core fundamentals around liquidity, keeping leverage low, making sure businesses can withstand macroeconomic shocks or idiosyncratic shocks is still the same concern, even more exacerbated now. In addition to that, focused on any supply chain related risks from Asia in particular.
So have you been talking with some of your portfolio companies, the companies you invest in, about these types of risks?
We are. We're focused on making sure we understand key liquidity, potential liquidity needs, if there's any derivative impacts that may not be as obvious but could come from an impact to their company, again, whether it be on revenues or on the supply chain side of their business. How do they get in front of those risks to mitigate them? When
you talk about liquidity issues, this is one of the big concerns, that companies will have debt maturing or financing needs that they can't necessarily plug at a time of potential volatility, as well as a decline in revenues on the heels of the coronavirus. What are you doing to make sure that your companies don't face those pressures?
First off, we focus on businesses that are based exclusively in the U.S. The majority of their revenues come from the U.S., so they don't have zero exposure to risk, but they're mitigated from a risk perspective of certain international issues. Beyond that, the focus is really making sure that we understand if they have any other debt, when does it come due? If they have any other liquidity potential needs, when might it come due, to make sure you're getting in front of potential liquidity needs, because it could take longer. Ultimately, we are a capital provider, so that liquidity challenge is, frankly, what we are there to solve for them. So it's really just making sure that we understand the fundamentals of the business, tracking them on a monthly basis.
Over the past 5 to 10 years, there's been a flood of cash into private lending, into small and medium-sized lending, in part with the belief that you will get bigger returns and not necessarily the same types of liquidity pressures as you would in public markets if there, say, is a forced batch of sales. I'm just wondering, going forward, does that calculus change at a time of lowering expectations for returns all around?
It's a great question. I think people's expectations for returns generally probably should be lower than they have been. I think folks like BlackRock do a good job forecasting different return expectations for multiple asset classes, yet when we speak to investors, they're never looking for the same returns that most people are forecasting for long term. They're looking for higher returns. Ultimately, I think that the focus has to be on fundamentals. People that are trying to get quick returns off of market disruptions are generally hard to achieve.
All right, so what is an appropriate returns target for a strategy like yours?
That's a great question. First and foremost, our focus on capital protection, so focused on recession-resilient businesses. If you look at revenue data, it's a surprise to a lot of people that U.S. lower, middle, and middle market companies actually have historically, over the past 5 years, had higher revenue growth and less volatility. Part of that is because they don't have access to the quick capital markets. They don't have access to the amount of leverage that larger companies do, which sometimes that works out well for a larger company and sometimes it doesn't. Smaller companies tend to not have access to those tools, and so they don't usually get in trouble as much. But I will mention there is such thing as too small. So startup related companies, I think, will likely face some real dramatic challenges if they're currently not cash flow positive as just a basic fundamental.
All right, Brett Hickey, thank you so much for being with us.
Pleasure.
Brett Hickey, Chief Executive Officer and founder of Star Mountain Capital. Coming up, this week's Power Player, Michael Grainoff, the Chief Executive Officer and founder of Pomona Capital. We will see how the rate cut, market volatility, and more are affecting the private equity market. This is Money Undercover on Bloomberg. I'm Lisa Abramowicz. This is Bloomberg Money Undercover. Now time for Power Player, our look at some of the most notable names in the industry. Today I am sitting with Michael Grainoff, Chief Executive Officer and founder of Pomona Capital. It is a fantastic day to have you with us here today as we have a global reassessment about growth, about rates, about the expectation going forward for a possible recovery to gain hold given the coronavirus and the subsequent slowdowns. Michael, I'm wondering from your perspective, as you look at the dramatic shift in sentiment, do you feel that you need to reassess any of your firm's holdings or approaches just generally to investments?
So obviously it's the question of the day. One of the nice advantages of being in the private equity business as opposed to the public equity business is that we don't need to respond immediately to big changes like this. And we'll be able to see how it plays out as it affects the decisions we make about investing one way or another. One of the interesting things about decisions like this, rate cuts like this, is that, of course, there's a positive and a negative spin. And having spent time in government and in business, the positive way to look at the rate cut is that the Fed is going to act aggressively to try to protect the economy, and that's a good thing. The negative side of it is that if the Fed thought that it needed to act in such a significant way at this time, maybe it suggests that there's more trouble in the macroeconomy than we knew. And so over the next little while, not just how people vote in the stock market today, we'll see which of those narratives is actually true, and we'll have to respond to those narratives one way or another. If we think that, in fact, borrowing costs are down and the economy is going to recover, well, that'll be an interesting input into how we acquire assets. If we think that we're in for a longer slowdown, well, that'll affect the pricing of assets as well.
How does the current private equity playbook change if the situation is more dire and the Fed is responding to a much worse economic outlook than previously thought?
Well, if you think about our business, so what we do, what we specialize in, is buying what we call secondary interests in private equity funds. So we're looking to buy interests in private equity funds from people who need liquidity. And in that respect, we're looking at every company and every fund, and we're trying to figure out how much money we're ultimately going to get and when we're going to get it. So if we think that we're in for a prolonged slowdown, that's going to affect both metrics. That is, it's going to take longer for companies to be sold or go public. We're going to have to hold them for a longer period of time. And it could be that the ultimate valuations of those companies, the multiples at which they trade at, and all of those kinds of considerations will change. And therefore, we need to build that into our models and make sure that we have an adequate margin of safety, because obviously we don't know the answer today to what's going to happen.
A lot of people say that private equity, private debt doesn't experience the same kind of shock as public markets when there is some sort of development, because there isn't necessarily trading, there isn't necessarily price discovery. That said, that doesn't really apply here, because there is trading in the secondary market, or has there been, in private equity secondary stakes?
So first, just a technical point, trading is not the same as trading in the stock market, right? So people are buying and selling in private markets, but it's not the same as minute-to-minute trading. So we don't have the kind of trading in the secondary market in private equity the way you do in public markets in that way. Your question, though, is an interesting one, because while I think that private market participants are, and we are, somewhat insulated from day-to-day volatility, certainly we are not insulated or uncorrelated with long-term economic trends. And one thing that people, I've been doing this a long time, one thing certainly people found out during the financial crisis was, if you thought you were uncorrelated to the world, you found out quite quickly that in fact you were. So there's a difference, I think, between being exposed to sort of the day-to-day volatility of things, minute to minute today, and long-term correlation with economic trends and economic markets. And so we may be insulated on the volatility side, but we are surely correlated one way or another on the long-term economic side.
Are you preparing to be a buyer if this does seem to be temporary and there is some sort of selling pressure on the other side?
So you're exactly right. So we are on both sides almost at every point in time, and we are looking for situations where there's some mismatch, and this may create opportunity where people are more distressed, where we'll have the chance to buy higher quality assets at a better price. And so our business is opportunistic in that sense. And so there is a way in which the assets we own will surely be affected by what goes on in the market today, but our ability to buy going forward and how interesting it is also going to be affected, and maybe in a positive way.
Just real quick here, would you be a buyer or a seller into this uncertainty, do you think? What's your gut?
So the lucky thing about our business is we don't have to swing today.
All right, Michael Gradoff, Chief Executive Officer and founder of Pomona Capital. Thank you so much. Coming up, we turn to this week's Billionaire Beat. We look at how the world's richest are being advised during this market volatility. This is Money Undercover on Bloomberg. I'm Lisa Abramowicz. This is Bloomberg Money Undercover. It's time for this week's big number. It is $444 billion. That is how much the combined fortunes of the world's 500 richest people lost during the sell-off in the last week of February. Which leads me to our billionaire beat. The question is, how are wealthy individuals dealing with the rout, as well as advisors? What are they telling their wealthy individuals as well as institutions? Bloomberg's Suzanne Woolley joining us now with that story. Suzanne, when we talk about $444 billion lost, it sounds like a lot, but probably they're not even necessarily managing their portfolios on a day-to-day basis, right?
No, and that is, that's their fortune, the whole $444 billion, and they sort of lost their entire year-to-date gains, which added up to about a $78 billion loss as of last week.
But it raises a question of what the goal is for the wealthiest individuals when they make investments and how they reallocate depending on a shift in sentiment. We certainly seem to be seeing a shift now with the Federal Reserve coming out with an emergency rate cut of 50 basis points, leading people to question the economic recovery. What are advisors telling wealthy clients?
One area that advisors are pointing to, particularly now, are the sort of the special situations, private market situations, looking ahead to economic dislocation, there's stressed companies, distressed opportunity, bankrupt opportunities. These are situations where if you have the liquidity and you have a long enough time horizon, you can really get quite an incredible investment.
So is it too simplistic to say they're just looking for bigger returns, but perhaps that they're also looking for some sort of lack of correlation or some sort of specific opportunity in that way?
Yeah, very much so.
Susan Woolley, thank you so much for being with us. And let's shift gears from wealthy individuals to one of the asset classes that they focus on, real estate markets in the U.S. and other countries. They rely on Chinese buyers, which has been an issue. They also rely on low interest rates, which is less of an issue as they seem to drop closer to zero. Rob Urban, who covers all things real estate for us at Bloomberg, joining us now. Rob, I want to start with that 50 basis point rate cut and get a sense from you. How much do you think that'll stoke demand from institutions for real estate?
Well, it probably will help strengthen the demand in the spring selling season. They call it the busiest time in U.S. real estate for domestic buyers and for more sort of average home buyers who might have been concerned that the direction could be up. Ultimately, rates are pretty low, and there are lots of other factors. But yeah, it'll probably help a bit. It's not calming markets that I can see, but
well, when it comes to real estate, though, there is a question, right? I mean, how much is it on a balance, the interest rate story versus a tourism and global story? And can you talk a little bit about just how much demand internationally has dropped off in response to what we've seen?
Well, we've been looking at foreign buyers in the U.S., particularly Chinese. Chinese are the biggest buyers of residential real estate in the U.S. Second is Canada. Third is the UK, Mexico is next. The Chinese like California. They like the New York region. They also look at Vancouver and Sydney and places like that. And last year they were number one at $13.4 billion, which was a 56% drop from the previous year. So it's already been shrinking.
There's a big question about what will happen with that. Bloomberg's Rob Urban, thank you so much for being with us. That does it for us. Reminder, you can watch us each Tuesday at 1 p.m. New York time, 6 p.m. in London, and 2 a.m. in Hong Kong. This is Bloomberg.